Good evening, everyone. So, March 2025 isn't crazy just for the politics and the geopolitics around Ukraine, around Donald Trump. It's also been a pretty crazy time for the markets all around the world. And today we're going to just try and unpack a few of the facts around these markets, especially the big three, as in US, India, and China. Uh, I'm covering India because I live there, and there have been some uh, ups and downs recently, and therefore it becomes important to kind of see what's happening. Just for some context, basically, there has been a lot of movement downwards in US and Indian markets, and there's been an upswing in the Chinese market. Now, this is a reversal of sorts of what was happening in the last maybe 3 years. And it is a bit of a surprise because investors seem to be dumping Indian stock, and now they're dumping the American stocks as well. The American stock downturn is kind of expected or was expected. The uptick in the Chinese stocks is rather unexpected. And the Indian story is the more interesting one as to why it has happened. So there's a small presentation on some of these things, and we'll unpack it as we go. I will have a podcast with a financial expert at a later date, hopefully in March as well. But before that, I'm going to share some publicly known figures that you can, just listen to. I'm not giving you any investment advice, so that's a disclaimer. This is just a discussion on what's happening in the world of markets and economy. So here we go. Um, so So I'm calling this the great divergence. So divergence is when uh, when you start having a very weird kind of situation wherein uh, some markets are doing very well, some markets are not doing well, and so on. So foreign investors have been pulling out of India in the last few weeks, and it has been pretty rapid, and it's been going on for a long time, as in the last almost 6 months. Now we need to know why or what has happened. So Indian economy did slow down in the first quarter of 2024. For India, that's the April to June quarter. And in a way, the market has been punished for it. And there are multiple reasons. Uh, you guys must be aware of it. But whatever it is, there has been a bit of a dumping by foreign investors of the stocks. But they will still, despite all the dumping or selling, they still own up to around 20% of Indian stock, on the main markets. Now, Nifty is now down 13% from its peak, and it has wiped out almost $1 trillion of market cap. So that's a big deal. I mean, that's a big number. Since October, they have withdrawn $29 billion. This is the biggest withdrawal by FPIs ever from the Indian stock market, of course, from a pretty high level. Now, Sensex trades. Sensex is one of the Indian markets uh, indicators and on the Bombay Stock Exchange. And this is still trading at around 20 PE, which is the price earning ratio, while the China's Hang Seng is at 7. Now, in a way, this tells you that the Indian story, the investors think is intact for the next 20 years, while the Chinese might be over in, say, 7 years. So that's the way to compare it, I guess. But it also shows that despite all of this pullout, the fact that India is still trading at that kind of a PE, this means that it is still a bit high compared to the Chinese market. I mean, that's almost a 3x difference. And just that number should tell you many things as to, how much confidence the Indian uh, economy is generating amongst the investors, and how much lack of confidence the Chinese economy has been generating for investors. However, the Hong Kong's Hang Seng has surged 30%, 36% since September, and therefore whatever was dumped from India is has really been going there. So that's one way to look at it. US Fed rate policies. Now, there are two more things that are happening, very interesting. China, for the first time, has put out a real big stimulus to draw investors. It seems Xi Jinping is taking a U turn. He had kind of destroyed many private industries around education and many others, and now he's begging for investments. So the Chinese authorities, after their big meeting in February, have come up with a stimulus plan, and some of it is working, at least from the market perspective. Um, RBI is still maintaining a very tight monetary stance, and that has limited the liquidity support for the banking sector, and which has depressed some of the uh, bank credit that the Indian industry or corporates can have, or at the rates that they can have, and this has definitely dampened some of the growth. Now, we'll come back to this. However, despite this sell off, as you can see, while the Chinese market has risen 36%, India, despite this huge sell off, has really dipped only 13%. So that's again almost a 3x difference. So you can continue to see that three times difference in terms of confidence in the Indian economy versus the Chinese economy. Now, the IT, FMCG, real estate sectors are the worst hit, while banking and infrastructure are holding strong. And that also tells you that the banking story is intact. Now, banks are like the base, the virtual base, and infrastructure is the physical base. So that's good news. The CPI, the inflation in India has dropped a little bit, which means that a rate cut could be around the corner. And basically, the RBI has intervened because the what's not mentioned on the slide is the rupee has gone down by about 3 rupees in the last 2 months or so, from 84 to 87 something. So RBI stepped in and has pumped in some measures to kind of keep the rupee in check, and also to inject some liquidity. So what RBI does is it does what are called open market operations, and basically RBI buys these bonds, and this keeps the interest rate stable and prevents volatility in the financial markets. It is also useful to manage inflation. Obviously, too much liquidity can also cause inflation. Now, what is the impact of OMOs on these markets? So, from the bond yield perspective, if RBI buys the bonds, bond prices rise and the yields fall, and therefore the borrowing becomes cheaper. For the stock market, lower bond yields can push the investors more towards equities, therefore will increase the stock price. On the banking sector, more liquidity makes credit cheaper, boosting banks and financial institutions. Now they're also using something called VRR, which is the variable rate repo auctions, which manages the short-term liquidity. So VRR is like a tool which where banks can borrow short-term funds from RBI at a market-determined interest rate instead of a fixed repo rate. In this auction, banks bid for these funds, and RBI allots liquidity to the highest bidder. So therefore, there's a matching of supply and demand. And I'm going through this so that you know what's happening in the background, because we're going to come back to some conclusions, which I kind of by chance showed you right at the beginning. Uh, so what is the impact of these VRRs on the market? So on the interest rates, VRRs are market driven, so they reduce the volatility in the short term. Banking sector, it helps them with some liquidity, and stock market, more liquidity in the banking system means some of the panic selling stabilizes. So all in all, both of these measures help the markets and helps the banks, both from the credit offtake perspective and also from supporting stocks. Now, basically, this has reduced the volatility, and that's why the market hasn't really crashed. It has definitely come down a bit, but not anything which is to be too much to be worried about. And these are measures are short-term measures, and they stabilize the market rather than fix anything permanently. Now, future outlook. Now, this is very interesting. Stanley has predicted that the inflows will start from second half, which is from July. Means there's another quarter of pain left. So if the market has come down 13% in 6 months, that 2% a month, a little bit. So another 6% pain might be remaining in the markets before they rebound. That's my top of the envelope kind of calculation. It could go either way. Uh, then long-term focus will remain on banking, infrastructure, and defense stocks for obvious reasons. The top two we've discussed. The defense stocks because there's a lot happening in the defense sector in India, and some of those companies are undervalued, and there are a lot of deals that the government has given them, and those companies are also getting deals from outside India. So that sector is going to pick up. Now, we've already discussed this. So basically, what this all of this means is that there's some short-term volatility in the Indian market, but overall, they're still structurally strong. Now, this was the presentation bit. Now, let's talk about what is happening in the US and China, for which I don't have slides, but I'm going to just talk about that. In the US, I think there is a lot of churn because of the tariffs regime, and the Fed has taken a stance recently that they will be doing two cuts this year. So the markets were kind of pricing it in. There could be some more pain in the tech sector, is what appears to be the way it is set up right now, because some of these tariffs will hurt different kinds of companies. Tech is one of them. A lot of other sectors will get impacted, especially the real economy side. The financials might still do well, but the fact is that if the US rate remains high, it'll definitely not be good for the rest of the emerging markets, because that'll mean the cost of borrowing will remain high. But for the Americans, for the US, it seems that the Trump administration might be wanting to have like a bit of a recession, a soft landing, as they say, and then pick it up slowly. But for that, there has to be a recession, and the market has to come down. There is a lot of debt. So if the stock markets don't do well, if the interest rates remain high, and the US fiscal deficit comes down, so therefore government spending comes down, obviously there's going to be some reduction in growth, and the tariff war will increase inflation. So I won't say there will be no pain, there'll be a lot of pain, but it might work out to US's advantage a couple of years down the line, once the slack is kind of over the hill. From the Chinese standpoint, now this is very interesting. The Chinese economy is not doing well from most accounts, and this is the very first time that they have really decided to come and do a stimulus. And for them to do a stimulus, this goes against all their proclamations, their strategy, their way of looking at markets, and so on. So this has been a real change in the way that they have looked at things. And 1 second, what did I click? So China is going to be an interesting story. I really wonder how long this allocation of FPIs from the Indian market will go to the Chinese market. I'm thinking that the sweet landing spot for both these markets would be a price earning ratio of 15 for the Indian market and maybe a 10 for the Chinese market. That'll reduce the differential by almost 3x. At one point, it was like India was way over 20, and the Chinese were way below 7. So that would be a real reversal of fortune in a way. But here's the interesting bit. Now, the real reason why FPIs are pulling out of India is because in last year in May, June, we had the Indian general elections, and some states also went to elections. So when the states go to elections, there is something called the Model Code of Conduct. So new projects are not announced. So whatever is being worked upon by the incumbent governments. Those works continue, but new projects are not announced. And that is the one quarter, the April to June quarter, is the historical quarter then where a lot of spending by the government perks up the growth historically. So that was a quarter where Indian economy didn't do well, and therefore the whole year has been affected by that. But this April to June, there will be no such elections, and in fact, there are not even any state elections. All of this is behind us. So we are going to look at a pretty solid expenditure, government spending, capex by the government in the coming months, from starting from April. So what will happen because of that is the growth will pick up. Now, the growth numbers are only announced after, say, June. So the June quarter numbers are announced in July end or August or something like that. But the investors come to know all of the numbers, how the companies are doing, how the sales numbers are doing. So therefore, they will get that information. That is why Morgan Stanley is saying that this bearish run in the markets will end by July. What will happen in the US markets or the Chinese markets, we don't know. But I like to hear what your view is on the Indian, US, and Chinese markets, and where do you think is the economy going? I must add that lower interest rates and lower oil prices will really help the Indian economy. Right now, the crude prices are lower, but the interest rates are sticky. So at least 50% of the job is done. Rest we'll see if it is. So this was Summit from Talks on Ground. Hope you enjoyed this. Do send me your comments and your criticism or whatever you think of the content in this video. Please like it and share it and subscribe to the channel. Thank you for watching. Good night.